Welcome to the debate. Imagine running a multi-billion-dollar business where your new primary strategy is to figure out how to work for absolutely free for an entire year.
Right, which sounds completely crazy.
It does. On the surface, that sounds like a fast track to bankruptcy.
Yeah.
But right now, some of the biggest technology firms in the world are doing exactly that. We are talking about the $315 billion Indian IT services industry.
The massive giants.
Right, the giants. TCS, Infosys, Wipro, HCL Tech, Cognizant, and for decades. These companies built their entire empires on a very simple model, right? Labor arbitrage. The simple math of hiring brilliant engineers in India for a fraction of the cost of those in Silicon Valley, and then just, billing clients for every single hour they worked.
But that entire model is being turned upside down right now. We are looking at what is essentially a historic inflection point.
Yeah.
Because when a new technology, specifically generative artificial intelligence, enters the battlefield, it fundamentally alters the math.
Completely.
If an AI agent can write thousands of lines of boilerplate code in seconds, or automatically resolve server tickets without any human intervention at all, well, the old moat of having 300,000 employees suddenly looks a lot less like a competitive advantage.
Right.
And a lot more like an enormous liability.
Exactly. And that brings us to the profound transformation we're examining today. The central question we really need to answer is this. Will artificial intelligence ultimately destroy the traditional business model of these Indian IT service giants, or will it save them by forcing a necessary, albeit painful, evolution?
Its outcomes is a strategic reinvention. It's a maturation that's going to not just save these market leaders, but ultimately elevate them.
And my perspective is that AI is a permanent and existential threat to these giants. It is actively destroying their core competitive advantage of massive human scale. We are seeing a real-time transfer of pricing power. It's shifting irreversibly back to the clients and to highly agile mid-sized firms who just aren't bogged down by legacy bloat.
Okay, well, let's get right into the mechanics of this, because to me, the data paints an optimistic picture of adaptation, not destruction.
Okay.
These giants aren't just sitting still while AI automates their revenue streams away. Take the data recently provided by TCS Chief Executive K. Krithivasan.
Right, the outcome-based numbers.
Exactly. He noted that roughly 80% of TCS's contracts within finance, human resources, and other business services are now based on outcome performance measures. And just to clarify what that means for our listeners, an outcome-based contract means the IT firm doesn't get paid just for showing up anymore.
Right.
They get paid for hitting specific metrics, like are they reducing the client's cloud computing costs by 20%? Are they successfully automating 50,000 customer service tickets a month?
Which is a staggering structural shift, honestly, considering that 80% figure has doubled just since AI really went mainstream in late 2023.
It is, it's massive. And I see this as the catalyst for a much-needed evolution in the industry. Because for years, the fundamental flaw of the traditional IT service model was misaligned incentives.
How so?
Well, if you're a vendor billing by the hour, your financial incentive is to take as long as possible.
Right.
But the client's incentive is to get the problem solved as quickly and cheaply as possible. So by embracing AI to deliver outcomes, these giants are proving they can adapt to the market's demand for actual value. They are tying their financial success directly to the success of their clients.
See, I look at the exact same data, but the macroeconomic reality tells a very different story. You call it evolution. The market is calling it a bloodbath.
A bloodbath is a strong word.
Well, look at it. This is an industry structurally built on the moat of human headcount. When AI automates the tasks that those thousands of employees were billing for, the moat evaporates. And we don't have to guess how the broader financial world feels about this.
You looking at the index?
Yeah, the Nifty IT Index, the benchmark tracking India's biggest tech service firms, tumbled by a fifth this year.
Yeah.
Its 10 constituents lost a combined $73 billion in market value. $73 billion.
Right, but markets often overreact to capital expenditure cycles. We see tech stocks fluctuate wildly during these transitional phases.
But a $73 billion wipeout isn't a mere fluctuation. It is a fundamental repricing of the industry's future. I'm sorry, but I just don't buy that. Let me tell you why. The shift to outcome-based pricing that you're praising, it isn't some proactive, visionary strategy cooked up in a boardroom. It is a forced concession.
You think they're being forced into it?
Absolutely. Clients are demanding steep price cuts because they know the IT firms are using AI to do the work faster. Or, which is even worse for the giants, the clients are just licensing foundational AI models themselves and shifting the tasks in-house entirely.
Okay, but
Jim and Aurora, the CEO of Everest Group, summarized this perfectly. He called it a desperate market for the service providers, noting that the odds are very much in favor of the clients right now. The IT giants are being backed into a corner and forced to accept terms they would have literally laughed out of the room 5 years ago.
well, if you're listening to this and wondering why a Fortune 500 company wouldn't just buy an enterprise AI license and do this themselves, we really have to look at how these massive deals are actually structured.
Sure.
Let's move from the broad market index to the specific anatomy of these new contracts. Consider the deal Cognizant struck with Daimler Truck in February.
Okay.
This wasn't a desperate concession. It was structured so that AI-related cost savings would actually be split between the vendor, Cognizant, and the client, Daimler.
Right.
So if Cognizant's AI implementation saved Daimler $50 million in operational drag, Cognizant takes a cut of that newly created value. That is the definition of a strategic partnership. As Cognizant's leadership stated, with AI, the fundamentals are shifting. We are reforging our model for that reality. They're capturing a piece of the upside.
Let me jump in there because the Cognizant-Daimler deal might look like a balanced partnership on a press release, but it is the exception, not the rule.
You think it's an outlier?
I do. If we want to talk about the real anatomy of these contracts, we have to look at the massive cloud management deal struck between HCL Tech and the European energy giant E.ON, which is slated for June 2025. Do you know how the payment terms on that multi-year deal are actually structured?
I know it's heavily backloaded.
It is completely non-existent in the first year.
Right.
HCL Tech will not be paid at all for the first 12 months. Zero. Payments starting in the second year are entirely tied to efficiency gains and specific business outcomes.
Wait, back up. HCL Tech is working for free for a whole year with E.ON?
A whole year.
As a business model, how does that not bankrupt them immediately? I mean, how is that justifiable?
Because clients know that AI has injected massive uncertainty into the market, and they have all the leverage. So E.ON is essentially telling HCL Tech, you take 100% of the upfront risk. You deploy your engineers, you integrate your AI tools into our European energy grid, you prove that your AI can deliver the efficiencies you promise, and if it actually works, well, maybe we'll pay you in year 2. That isn't a strategic partnership. That is absolute capitulation.
I mean,
the IT giants are bleeding themselves dry, taking on enormous financial risk just to keep their logos on the client's roster.
That's an interesting point, though. I would frame it differently, because that is definitely a jarring contract structure, I'll admit that. But I don't look at the E.ON zero pay first year as capitulation. I think we have to look at it through the lens of a venture capital investment model.
A venture capital model? We're talking about a traditional IT service provider acting as a VC?
Exactly. I mean, think about how venture capital actually works, right?
Okay.
You absorb a high degree of upfront risk. You inject capital, time, and resources at the beginning of a cycle with the expectation of capturing massive back-end scale and outsized returns once the thesis is proven. What HCL Tech is doing is effectively investing its own resources into E.ON's infrastructure for a year.
But why does it take a year? Why wouldn't the AI efficiencies kick in by month 2 or 3?
Because you can't just plug a large language model into a 30-year-old European utility company and expect it to magically optimize their grid.
Well, sure.
You won't have to spend months cleaning unstructured, messy legacy data. You have to map the existing infrastructure, ensure global regulatory compliance, train the models on proprietary systems. It takes a year of heavy lifting before the AI efficiencies can actually be realized.
I see that, but...
And here's the crucial point. Absorbing that kind of upfront risk requires an incredibly robust balance sheet. Only the traditional giants have the financial luxury to work for a year without revenue to secure a massive, sticky enterprise client. It actually proves my point. Their legacy scale gives them the financial runway to survive this AI transition. It's a luxury smaller firms simply don't have.
I understand the VC analogy, taking a hit now for a payout later. But you're assuming their legacy scale is an advantage.
It is.
I'd argue it's exactly what's dragging them down against the smaller mid-tier firms.
How so?
Well, AI has fundamentally leveled the playing field. In the past, winning a global enterprise contract required pointing to an army of 200,000 developers.
Right, a massive workforce.
It was a numbers game. But today, as one industry insider noted, the demarcation of a scale player only by revenue is not necessarily a big thing anymore, because AI automates the heavy lifting, writing the code, testing the software.
Sure.
So mid-sized firms can punch massively above their weight class. And we're seeing this play out in the financial data right now.
You're referring to the recent quarterly surges in the mid-tier?
Yeah, it's brutal competition. Look at mid-size IT service providers like Persistent and Coforge. They are eating the giant's lunch.
Okay.
Both have seen revenue in dollar terms grow by double digits for at least 8 consecutive quarters. In the April to June period alone, Persistent's revenue surged 16%, and Coforge jumped by a third, 33%.
That is significant.
It is. Contrast that 16 to 33% growth with the traditional giants. TCS, Infosys, Wipro, and HCL Tech posted subdued growth of just 1 to 3%.
That is a stark contrast in quarterly growth, I'll give you that.
It is. And why is it happening? Because the mid-tiers don't have the bureaucratic bloat of the giants. They offer flexible pricing, and they can deploy senior leaders incredibly fast.
Yeah.
Bill Furst, the CEO of HFS Research, noted that these Tier 2 firms have been agile and hungry in this phase, winning mandates by developing rapid pilot programs for clients. The clients aren't buying the venture capital narrative you're selling. They are taking their budgets to the agile mid-tiers who don't have a massive legacy workforce to protect.
I'm not convinced by that line of reasoning because I think there's a vast structural difference between winning a rapid pilot mandate and running global enterprise architecture.
But they're winning real business.
Yes, Coforge and Persistent are experiencing a fantastic growth sprint right now. They are agile and they are excellent at swooping in to deploy an AI pilot program. Let's say, building a localized generative AI chatbot for a company's HR department to answer employee benefit questions.
Right.
That is a great win, but a pilot program is contained. It's inherently low risk.
But those pilots scale. That's the nature of AI. Once a client sees the HR chatbot works, they want to apply that same technology to their core operational data.
They scale in capability, sure, but integrating them across a Fortune 500 company's entire legacy backend is a completely different beast.
Is it though?
Absolutely. You're talking about ensuring global data privacy across different sovereign borders, managing algorithmic bias, guaranteeing zero downtime for mission-critical systems.
Right.
That requires enterprise-grade architecture and massive liability coverage. The mid-tiers are winning the skirmishes, the pilot programs, but the giants are restructuring for the war.
Restructuring.
Yeah, that 1 to 3% subdued growth from TCS and Infosys isn't a permanent defeat. It's the financial friction of a massive, deliberate restructuring phase. They are purposely cannibalizing their own low-margin, high-headcount contracts to make room for these higher-margin, AI-driven outcome contracts.
See, cannibalizing your core business is only a successful strategy if you actually capture the new market before someone else does.
Which they are doing.
Well, which brings us to how the CEOs of these giants are analyzing and defending their market vision.
Okay.
The software world globally is terrified of AI rendering key parts of their businesses obsolete. But India's IT industry is the absolute most obvious victim here.
I wouldn't call them victims.
I come at it from a different way. Because when you listen to the leadership of these firms, they're spinning a narrative of total control. They speak about reforging models and strategic shifts. They project an image that they are the ones driving the AI revolution rather than being run over by it.
Because they are the ones implementing it for the world's largest companies. They're the vital bridge between the raw foundational AI models being built in Silicon Valley by OpenAI, Anthropic, or Google, and the actual practical deployment of those models in traditional industries like European logistics or American banking.
Sure, they implement it.
The CEOs are accurately diagnosing the shift. They recognize that clients now demand rapid development and more productivity, and they are adjusting the ship accordingly.
But the broader market simply does not believe their rhetoric.
Based on the index drop,
Based on the fundamental mechanics of the business. You said earlier that markets overreact, But a $73 billion wipeout across 10 constituents of the nifty IT index is a very clear referendum on the CEO market vision.
Well, markets are short-sighted.
The market is saying, we see through the optimistic PR. Your revenue historically is tied to billing humans by the hour. AI replaces humans. Therefore, your revenue will shrink.
It's not a one-to-one replacement, though.
But the unit economics shift from selling a highly predictable commodity, human time, to selling an unpredictable outcome, AI efficiency. The narrative of control is just corporate signaling to soothe shareholders while the foundation crumbles.
Okay, if I can reframe that, I think we need to look at what that market signaling actually represents. The CEOs of these large firms, companies that essentially built the modern Indian middle class through their hiring practices over the last 30 years, they understand exactly what inflection point they're at. If they try to protect the old model of billable hours, they will die.
Agreed.
Slowly, perhaps, but certainly, by proactively telling the market, hey, we are moving to outcome-based contracts, we will absorb the upfront risk, and we will share the AI efficiency gains, they are doing something incredibly difficult.
They're shrinking their revenue.
Exactly. They are deliberately shrinking their short-term revenue to secure their long-term survival. That isn't just PR spin. That is the definition of strategic foresight. They are burning their own ships, so they have no choice but to conquer the new territory.
The problem with burning your ships is that you better be absolutely sure you can win the battle,
Right.
or you just end up stranded on the beach. And right now, the clients have the upper hand. Clients are demanding shorter contract durations because they don't want to be locked into a 5-year deal with an IT service provider if a new AI model drops tomorrow that makes the current service entirely obsolete.
That's a fair concern.
The power dynamic has fundamentally shifted. The IT service giants used to hold the keys to the kingdom because technology implementation was incredibly labor-intensive.
It was.
Now, technology implementation is becoming automated. The keys have been handed back to the clients, and the mid-tier rivals are slipping through the open gates.
That perspective implies the technology will become so seamless that companies won't need expert partners to manage it. But historically, every single time technology becomes more powerful, it also becomes infinitely more complex to govern.
True.
The Fortune 500 will still need massive, reliable partners with deep pockets to manage that complexity. They will just pay them for the outcomes they achieve rather than the hours they sit at a desk. And honestly, I argue that the profit margins for these IT giants will actually expand once this transition period is over.
Wait, how do you figure that? If they are losing their massive scale advantage, how do margins expand?
Think about the shift from renting physical DVDs at Blockbuster to subscribing to Netflix. It's a total rewiring of unit economics.
Okay.
If you are billing by the hour, your margin is strictly capped by how much you can mark up a developer's salary. It's a linear growth model. But if you are billing for outcomes, if you are taking a percentage of the hundreds of millions of dollars you save a global logistics company like Daimler Truck through AI optimization, your upside is completely decoupled from your headcount. It becomes exponential. That is why AI will ultimately save these giants. By forcing them out of the linear time and materials trap, AI is pushing them into a higher value, exponentially scalable business model.
I don't know if
The pain we are seeing in the nifty IT index, the subdued 1% growth, this is just the friction of rewiring the entire machine. The massive deals, the willingness to restructure contracts, the shift to performance measures, it all proves they are successfully adapting for a new, much more lucrative reality.
Or is to continue your analogy, the machine isn't being rewired, it's just being unplugged.
Unplugged.
I maintain that the core DNA of this $315 billion industry has been permanently, irrevocably fractured.
Fractured.
The Indian IT service miracle was built on a very specific, unique advantage: massive, high-quality human scale at a lower cost. AI has stripped that advantage away.
Well,
It has empowered clients to demand more for less, shorten their commitments, and even bring capabilities in-house. And it's empowered mid-sized competitors like Coforge and Persistent to outmaneuver the giants in real time.
right.
The transition to outcome-based pricing isn't a visionary, evolutionary leap. It is the frantic paddling of an industry trying to stay afloat in waters where they simply no longer control the current.
It is a fascinating structural shift. And I think we can both agree that looking at the raw data,
Understanding the mechanics of these zero-pay contract structures, the quarterly growth disparities between the mid-tiers and the giants, and the deep market cap adjustments, well, it reveals a much more complex story than the polished corporate narratives alone.
Absolutely. Because the true tests of this entire debate won't be settled by CEO speeches or market visions. It will be settled on the balance sheets over the next 24 months.
Exactly.
The ultimate fate of these service giants will depend entirely on whether those new efficiency-tied contracts like HCL Tech's massive gamble with Eon actually pay out the massive dividends they are promising in year 2 and beyond.
Yeah.
If they can survive the first year of absorbing risk and actually deliver the AI outcomes, the giants live to dominate another decade. If the efficiencies don't materialize, the industry as we know it fundamentally breaks.
It's a high-stakes gamble with the future of global tech services hanging in the balance. We invite you, our listeners, to continue exploring the fascinating economic mechanics beneath this transition. The next time you read a headline about AI taking jobs, look closely at how the financial plumbing of these megacorporations is adapting.
Yep. Keep an eye on the numbers.
The transition from billable hours to measurable outcomes is fully underway, but only time will tell if the new foundation can hold. Thank you for joining us on The Debate.